All right. Crystal, are we ready to march ahead with benefits? Okay.
Right.
So, go ahead. Karen, you're up there. This is Karen Williams, and she is with Employees Group Insurance, which is part of the A&I Human Resource. A&I stands for Administration and Information. You'll hear lots of acronyms. So, Administration and Information, Human Resource Division, which is kind of the governing entity over all agency human resources offices. Karen's part of Employees Group Insurance, and she has graciously agreed to come here and talk to us today about benefits.
At least I got you early, so you're not, right after lunch or real deep insurance. So we'll make this informative and as exciting as possible. I've been with Group Insurance for 13 years. I'm pretty happy to be a state employee, and I realize I'm kind of biased, but we have pretty good benefits. And of course, the benefits and insurance has become pretty volatile with all the different laws and the Affordable Care Act and things. So I think we've got a pretty good deal here at the state. So part of what you should already have, it looks like on your desk there, is some of this information. There's a new hire checklist, and that's kind of informative to make sure that you know what some of your rights and responsibilities are, as well as the agency making sure that they've informed you of some of these things going forward. You should be getting booklets. Right now, we're waiting for the 2017 book to be reprinted and put out on the website, but there is a 2016 book that you can get, a Delta Dental book, there's a life insurance book, the applications, I've seen it on some of your plates, so to speak. There's an app for health, dental, and life. There's an app for the voluntary, and your flex election form, so you should have all of those. And we'll go over those benefits in detail. This is the new hire checklist. One of the most important things to know is what your date of coverage is going to be. And we, in essence, means date of eligibility, the date you're eligible to be covered. So if you got hired on February 1st, you're eligible for benefits 3/1. So that's your date of eligibility. And the reason that's important is that most people just get their apps in right away and they make their decisions, and they try to get folks to do it typically the first of the month following your date of hire, but you have 31 days from the date you're eligible for coverage to make any revisions. So if you got hired on February 28th, you have until the end of March to get your apps in or make any changes. If you're hired on February 1st, you still have until March 31st because you have 31 days from the date your coverage would start to enroll or revise. Your applications must be turned in within the 31 days. That's everywhere because you just can't state it enough. Your coverage does start first of the month following your date of hire, unless you're a TPO1. And then there's a 90-day waiting period that we can talk about more. I want to explain how the state contribution works. There's a set amount you'll see on our website for single coverage, employee plus children, employee plus spouse, and family. And the way this works is that the contribution pays for your employee life insurance first. So you won't ever see it on your paycheck. If you elect it, you just won't see it because it's not an employee deduction because you didn't pay it. Your fringe or match paid it. Once your life insurance is paid, then your health insurance applies towards it. And most people and most deductible options will leave you having an amount that's owed. So just to know how that contribution works, it applies to health, dental, and life, just those three basic benefits, and all the other benefits we have are considered voluntary benefits that you pay for. Dependent eligibility, we just want to make it known up front that we didn't used to do this, but it is an industry standard that we require verification that your dependents are really your dependents. That means if you've got children you're putting on your policy, we need a birth certificate to show that they're your dependent. A spouse, we need a marriage certificate to know that you're legally married. We do have situations where if you're adding single coverage, if you're putting yourself on coverage and a stepchild, say, that's it, we would need your marriage certificate and their birth certificate to tie that stepchild to you. It is required within 31 days of the application deadline. So we talked about you have 31 days from the date you're eligible for coverage. If you turn your app in on time but don't have that birth certificate yet, you have 31 days from the deadline of the application to get it in. And that's in any situation. Somebody 2 years down the road, somebody has a baby, those rules still apply. But just know that we require verification that they're yours. I don't know that this is going to apply to everybody, but just so that you know, split coverage is really family coverage. And this was instituted to make sure it was equitable for two agencies. So you work at Health and your spouse works at WYDOT, there's no reason Health needs to be on the hook for the entire family contribution. So it's family that we split in half. Half comes out of your paycheck, half comes out of your spouse's, and then the contribution from the agency is also equitably split. But you have to have employee, spouse, and children. I mean, it has to be family. If it's just you and a spouse, and you both work for opposing agencies but there's no kids, then it's two singles. So if you hear the word split thrown around, or you're told that you might be split, it's probably going to raise questions, but you've got HR or you've got us. So just to know that it exists. Effective dates, again, first of the month following your date of hire is typical, unless you're TPO1. Any kind of revisions and deadlines, your applications must be signed by HR within 31 days from the date you're eligible for coverage. And in the future, if you have any kind of qualifying events, that used to be 31 as well, but we've extended it to make it 60 days. So you've got a spouse, you've got a baby, you've got 60 days from that event to get your apps in saying, hey, I want to put Joe on my coverage. And then from that app deadline, you'd have up to 31 days to get your supporting documentation in. So the most basic question is, what insurance do I want to take? What deductible? What are these plans about? So the best way that I can, from a layman's standpoint, explain it is the apple and the orange. They're not the same. You can see here that there's a 500/1000. That's a deductible choice. In the Cigna book, it's called option 1, option 2. But when you look at your application, there's a lot of information squeezed on there. It says 350, 500, it says 900. So we call them by the deductible name. The way this works is that the 500 is an individual deductible. So you've got 4 people on the plan, and you go to the doctor and you are assessing your deductible and paying your out-of-pocket deductible. You meet your 500. Woohoo! Now that the 500 is paid, your claims go to a co-insurance or a percent. So preferably 85% if you're seeing a networked doctor in Wyoming. The reason that that's beneficial is that if there are 4 of you on the plan and you're the only one that needs services all year, you're not waiting for anyone else in the family to meet any additional deductible. You meet your individual, boom, you go straight to a co-insurance percent. What's good though with 4 people on the plan, just using it as the example, if you meet your 500 and your husband Joe meets 200 and then one of your kids meets more, it's a cumulative family. So once $1,000 is met for the family for that calendar year, there's no more deductible. So Johnny the third goes in and the family's already been met, he just doesn't have any. So it's a single and or cumulative family. If there's only 2 of you, then that's the math. 500, 500 is 1,000. But that's how that works. So both employee and families have a deductible. On the Apple, you've got prescriptions that are set copay, so that when you go into the pharmacy, you know up front, you're going to pay either 10 for a generic brand, generic prescription, 20 for a preferred brand, and 50 for a non-preferred brand. So the point there is that it's preset, and there's still 3 choices, but it's going to be one of those 3. You're not going to go in and get some antibiotic and pay $800. You know you're paying 10, 20, or 50. So for colonoscopies is a wellness benefit. Those are on this Apple are paid at 100% every 5 years, regardless of any kind of a diagnosis. That's critical because the orange is different. So a high deductible health plan can only be called that if it meets the IRS guidelines to be considered a high deductible health plan. Clearly, we've got a 2,000, which would be higher than 1,500, but the way the plan is designed, it doesn't qualify as a high deductible health plan. In order to qualify as a high deductible health plan, the deductible is a one or the other. So if it's just you, you've got 1,500. If it's you and a whole family, or you and one kid, or you and a spouse, anything more than single, you've got a $3,000 deductible, and it has to be paid before anything pays on anybody. So it's, if you've got a family of 5, that's, or I don't have $3,000 in the bank, so I can't, I'm not willing to take that risk. But just know that that's the way it works, it's one or the other. To meet this qualification. The other part is that on the orange, your prescriptions are part of the major medical. So unlike those preset copays, it's going to fund your deductible. So you go to Albertsons and get an amoxicillin, it might be, there's still a discount. You still want to present your Cigna or your prescription ID card in order to get it to apply to your deductible, and there's still a discount involved, but you may be paying $150 for an antibiotic versus $190. I'm just making that up off the street, but it's going to apply to your deductible. So those are the two really big differences in this orange and apple. The other part is that the colonoscopy is covered every 5 years at 100% if it's diagnostic. And a lot of times somebody who goes and gets a colonoscopy, hopefully they don't find anything, but if there's a polyp and they remove it, it's now a medical procedure. So that's going to apply to your deductible. So it's different. You just want to be made aware of it. And the reason that this is important is once we get into some of the other benefits, you can have them if you have the orange, or you can have it if you have the apple. So it just depends that way. Any questions right off the bat with deductibles before we just move on? No. So once your deductible's met, then you have this co-insurance. And for me, the easiest way to explain this is, I don't want to say you're a winner because that's not nice, but if you're in network and in Wyoming, in, it pays at 85%. If you're not both in and in, this doesn't sound right, it's 75%. So a Wyoming doctor who's not participating as part of the network is going to pay 75%. And even if they are in network but they're in Colorado, it's going to pay at 75%. If you're out and out, it's 60%. I mean, if you're in Idaho on vacation and decide to go in for sinusitis, that's not an emergency. It needs to be treated, but it's paid at 60%. It's always advisable that you see an in-network doctor. Even if you're getting your claim paid at 75% after your deductible, if your doctor or provider is participating, they may pay Cigna pays 75%. You're on the hook for the other 25%. But if they're non-par or they're not in network, you can get stuck holding the rest of the bill. If you're in Wyoming and they're not participating, if they are participating, you just pay 25%. But you just got to be careful. I mean, at least you're not locked down to not having benefit. If you decide you want a doctor in Colorado, say, and they're in network, it's still going to pay at 75%. But just be aware of what your responsibility would be. And then if there is emergency care, you're in Idaho and there's an emergency, it's just going to pay at 75%. It's those things you do outside of the state and outside of network that aren't emergencies. Those are the things that kind of ding you at 60%. So, all right, so that's the health, and we can go back with any questions you guys have as it sinks in. The dental insurance is pretty straightforward. There's a preventive dental and an optional dental. Preventive dental is required if you take the health insurance. That typically comes down to the fact that if you're not taking care of your mouth, you can get bad stuff happening to your body. So your mouth is an indication of the rest of your health. So it is required if you have health, you have to have preventive. There's no deductible or anything with this. Services are covered at 100% for diagnostic and preventive services. That's if you're seeing a contracted dentist. And Delta Dental of Wyoming is the big name in town, and just about all the dentists are contracted. But you should check on yours. Covers exams and cleanings twice a year, so long as they're separated by at least 5 months. Covers bite wings every 12 months and full mouth x-ray every 24. So it's just basically all of your preventive and diagnostic stuff. The optional is optional. However, if you don't take it when you first can, there's a 3-year waiting period to try to get it again. You can't, well, my teeth are good. And then you find out 6 months later you need a crown. Sorry, Charlie. So if you take it, there's a $50 deductible per year per person. But kind of like the health, there's also a cumulative family. So if I need 50, my husband needs 50, and then my son goes in and needs to have a cavity or something, there's no deductible. It maxed out at 100. Services are paid 50% after your deductible for your major services. And this just changed January of this year. Everything was always 50-50. So it's just changed to 80% for basic services. And that's your cavities. I'm not going to get too detailed. You need to read the print in the Delta Dental book, because there are some root canals, I believe, are part of 80%. Some crowns are, some crowns aren't. But at least it's not 50-50 across the board. There are some services that are covered 80%. However, you are still limited that Delta Dental will only pay out $1,500 per year per person. So if I have 2 crowns, that's a bad example, if I have 2 root canals, I'm just going to meet my $1,500 faster. But if I have 1 cavity throughout the year, yay, I got paid at 80%. So, but if you don't take the optional and you only take preventive, you can get your cleanings and your x-rays, but you're not going to get anything paid for any corrective work or restorative work. And again, if you don't take it, you've got to wait 3 years. So it's February. I'm just going to, assuming people got hired in February and you don't take it now. So you think, okay, 3 Februarys from now, that's 3 years, but we only allow you to enroll during open enrollment, which is in November. So you could wait upwards of 4 years. So you have to admit at least the full 3-year waiting period and then do it during open. So we do offer life insurance that just changed carriers to standard as of January. And these are the rates for active employees. If you want dependent life, you have to take employee life. Of course, we don't want you to insure your spouse, but not insure yourself. So if you want dependent life, you have to also take employee life. Dependent life's a whopping $146. That's it, and it covers however many dependents you have. We don't list those dependents. Gosh forbid, at the point of an issue where somebody were to file a death claim, a life claim, we would just verify that they were really eligible and that you were paying for it, and then we would be good to go. If you don't take life insurance when you're first eligible, you do have to go through proof of good health later, which means standard will either approve you or deny you. This is the voluntary application. You got it in your packet. I just wanted to show it to you. We don't have booklets per se on the voluntary benefits, so the back of the application gives you a pretty good synopsis of how the vision works and how the disability works. On the front of the application, the state does offer long-term care. It's not payroll deducted any longer, but this is how you would certainly enroll in it and make payment arrangements through Genworth. That's who the long-term care is through. This will also give you information on the vision that if you don't take it, you have to wait for 2 years. If you do take vision, you have to commit to it for 2 years. We don't want you to get on, get your glasses, and then just jump back off. So you've got to keep it for 2 years. Disability also has some penalties. Short-term disability, especially as new hires, most new hires don't have a bank of time. So gosh forbid something happens to you, very seldom do you get something that insures your pay. So short. It's on the next screen. I'll go into it. Read the back of the form. And even though we don't have a booklet, we've made a brochure that's out on our website as well. So if you want to print this off for yourself, because you're going to turn your application back in, this kind of, again, gives you just a synopsis on how the vision is built, how it works, same with the disability and the long-term care. So the vision benefits are, you've got 2 options on your application. There's Plan C and Plan B. And really the only difference is how often you can get frames. If you get frames every single year, it's the higher priced one because you're getting them more often. Both plans, you get an exam every year. Both plans, you can get lenses every year. Frames, 12 months versus 24. Contacts you can get every year. And then there's a material code. If you're going for an eye exam, which is, I think, it used to be about $90 before I had the VSP. I think it's running more like 130 these days. So you're going to pay $10 for your eye exam. So it's pretty straightforward. On your materials, you're going to get lenses or frames. There's a $25 material copay, and then you get a $160 allowance towards your glasses. I went into Shine Eye Clinic and got these a couple weeks ago. They were going to cost me $150. That's with the allowance, with my material copay, and they had to add a tiny bifocal, which doubled it. But it's like a prepaid vision plan because you're paying $16.78 a month, say, for vision, and you have to keep it for 24 months. So you can multiply that by 24 and see what you're going to pay. But the amount of money you save by getting glasses, getting your exam paid at a whopping, that you only have to pay $10, it's a pretty good benefit. But it's very defined. And I will tell you, VSP is the best customer service ever. So refractions and lots of those other terms that I'm not an eye person, so you can contact VSP's customer service with any kind of scenarios, or this is my situation, and you could do that before you enroll in it even, if you wanted to really figure out whether that's just a good benefit for you. Short-term disability, I've been in the state for 13 years, and I still carry both short and long. Like I said, new hires don't usually have a bank of sick or annual, so if something happens to you, short-term is going to pay out 66 2/3 of your gross pay. We make this benefit come out of, if you elect it, comes out of your paycheck on a after a tax basis, so you pay taxes on it. Your income is taxed, and then your insurance is deducted out of it. The reason that we make it that way is that if you, gosh forbid, had a claim, not only are you getting 66 2/3 of your gross, but you don't pay taxes on that money that you're receiving as income. So it's pretty good. And even though I've got a pretty good bank sick time at 173 hours a month that you would typically use, it's only going to last me 3 months. So then I'm out of sick time, and this will pay up to 6 months, so I continue to carry it. There is a 14-day waiting period, so if I have a claim, I'm out of work, I'm disabled, I'm going to have to wait 14 days, and then it'll start kicking in and paying. If you don't take this as a new hire when you're first eligible, but then 6 months down the road decide, crap, I should have taken that. Bottom button. I'm sure my finger hit it.
I'm not sure what happened here. There we
Oh,
go.
sweet. Okay. If you 6 months later you decide, oh, I should have taken that, you can enroll in it and we'll give it to you. But during that first year that you have it, there's a 60-day penalty. So if you file a claim in that first year, you can get paid, but it won't pay out for a full 60 days. That's the penalty. Once a year has come and gone, you're good to go. You're back to the 14-day window like everybody else. So what tends to happen is if somebody finds out they're pregnant, they're like, oh, I should have taken it. This isn't necessarily going to help them because that 60-day penalty that they make you wait before they pay, pregnancy or delivery is usually a preset amount of time, so you're just not going to get anything. So if a person was trying, they should make sure they have it. Long-term disability picks up at the end of 6 months, and that pays 60% of your gross monthly income. And that can actually pay up to the age of 65. I'm not sure how you stay employed that long. And there are people that if you are on claim and a person has had to actually terminate employment since they've already had the claim ongoing, Standard does continue paying it out. So I find that amazing too. But it's one of those things that I'd rather pay for it and never need it than need it and have no income. So there's something to consider. Long-term disability, if you don't take that as a new hire and you decide you want it later, you can apply for it, but you've got to go through an underwriting process, and Standard will either approve you or deny you. So sometimes it's best to take it, read through the certificate or the material, and then you could, these short and long-term, you can drop at any time, unlike the vision where you have to commit for 2 years. Any question? I'm trying to make sure I make eye contact with you because I know that this is interesting information and I'm throwing it at you pretty quickly. So stop me or please slow me down if you need more. I don't mean to.
If you change agencies in state government, can you elect to take it again?
No. If you go from health to YDOT, or we cover the community colleges, it's just considered a transfer. So unless you actually terminate, you paid all your sick and annual, and you sever employment, and then you get hired, later by somebody else. But otherwise, it just flips. You're not really considered a new hire, just a transfer. So flexible benefits, you've got this form as well. This one is the primary one. This is just what the form looks like. Let me go to this other screen. This breaks it down closer. So you can see here the black banner that this insurance premium, whether your insurance is pulled from your paycheck and then you pay taxes, which means you didn't pay tax on the insurance premium, or you pay tax on all your income and then your insurance is deducted. I know that we work for the government, but I just don't want to give the government any of my money I don't have to. So if you do it pre-tax, depending upon how much premium comes out of your paycheck for the health and the dental, you just don't pay any taxes on that particular amount of your income. But if you take that, you're locked into your benefits. You can't just make changes willy-nilly. The IRS says, hey, if we're going to give you a tax break, you need to be locked into your insurance unless you have a qualifying event. If you take post-tax, you can drop your insurance anytime you want, unless there's a waiting period, commitment like the vision and the dental. But you could drop your health if you were post-tax. You could drop your kid off your plan if you were post-tax. You don't need any kind of qualifying event. You just aren't getting that tax advantage by not paying tax on, I don't know, $100 of your premium. So if you have questions about that, you're welcome to give our office a call. Once you make that election, it stays in place every year until such time as you fill one of these out and say, hey, I want the other. We don't make you fill it out every year. The other part of the page, however, is where your reimbursement accounts come in, and these you actually have to do every single year. I got to tell you, if you've never experienced medical reimbursement accounts, it is the bomb. It's interest-free. I say that because I had a dental implant in January, I don't know how many years ago, and the medical reimbursement account says that you could be reimbursed even though your money hasn't been put into the account yet. So I'm electing $100 a month to come out of my paycheck to be set aside pre-tax. I'm not paying tax on it, which is awesome. And then when I file a claim with group insurance, here's my EOB from Delta Dental that says I'm responsible for X amount for my dental implant. You're reimbursing yourself with your own money, but I can't get the credit union to give me $1,600 or $1,200 interest-free. I'll just pay it back $100 a month. So it's really cool that you can not pay tax on this money and you can get it right away. You have to have a qualifying medical or dental expense and file a claim. So there's the standard business hoops in there, but it's really pretty cool. The maximum right now is $2,500 a year. You can divide that out by however many months of employment you have in 17 and deduct that amount. There's another slide in here on Flex. We also have a daycare account, and that allows you to do a maximum of $5,000 per family, which is standard for IRS. And again, you have, say, $400 a month pulled out of your paycheck. It's set aside. You need to pay taxes on it. And then you file a claim with group insurance, and then you get reimbursed for your daycare expenses as you claim them. And then we have a wraparound medical reimbursement, which I'll talk about in just a second because it comes into play a little bit more complicated. Why would you want to do pre-tax? Other than not giving your money to the government, you actually have more livable income. Because instead of giving that tax to the IRS and then maybe getting a tax refund at the end of the year, you're not paying that tax, putting that money back in your paycheck. So you have more livable income. So medical reimbursement, set aside money pre-tax for medical expenses, prescriptions, vision, dental, medical. It is a maximum of $2,500 per year per employee. So if you and your spouse both work at the state, or your spouse works at the city of Cheyenne and you work at the state, each employee can do $2,500 per year. You do have to submit a claim. It is still paper, and then we reimburse you the money. IRS does give some limitations on what can be reimbursed. So there's anything that's considered cosmetic, experimental. The state's program doesn't allow reimbursement for over-the-counter prescription, over-the-counter vitamins, those kinds of things. So even though it's your money, it still has to be an eligible reimbursable expense. So the thing you want to make sure too, if you know you have X amount of prescriptions, you know you're going to get a pair of glasses this year, you can set aside the amount of money you think you're going to be able to get yourself reimbursed back. You don't want to put in $2,500 and then find out, I don't really need that ACL surgery, because if you can't use it, you lose it. We keep it. The IRS says there has to be a risk on both sides. So I claimed that $1,200 at the beginning of the year for my dental implant, and then in March I quit the state. Group insurance is just out the money. We don't go back after it. So the risk on our side if you quit, and there's a risk on your side if you can't claim it. I have known of a couple of folks who thought they were going to have a couple of root canals, and so put $50 a month aside to get that reimbursed once they had the services. Found out they didn't actually need the root canal, and then were kind of forced to just get a couple of pairs of glasses to ensure that they got their money back. So, but if you can underestimate, you're good to go, or just know that you're going to spend it, but you don't want to lose money. That's not the point. Daycare. The difference with daycare, I told you the medical reimbursement, you can have it before the money's there. You just have to have a claim form and an actual EOB from Cigna or Delta or your prescription receipts, and you'll be reimbursed the money. Daycare, the money has to be there first. The services also have to have been incurred. So, you pay your daycare up front in January because they don't give you services without having paid for it. But we don't necessarily reimburse them until the services have been incurred. So you kind of have to afford to be a month ahead in your daycare. And when I had one that was young enough to be in daycare, when you do this on your taxes at the end of the year, you still end up with the same tax credit at the end. It's taken off of your taxable income. So it's whether you want to do it ahead of time or you want to do it after the fact. But when we're talking about the medical, I think the IRS has increased the amount you have to itemize your medical expenses to like 11.7. It's really tough to get 11% of your income to itemize that. So that's the other reason why the medical reimbursement is so great, that to not pay taxes on $2,500 versus whatever 11% of your income is just another advantage to get that tax savings. This you also have to file a claim for, and then we do direct deposit now. But we either cut you a check or it's just direct deposited into your account. So the wraparound medical reimbursement is a special medical reimbursement, and it's a tool. So if you have the orange, which is the high deductible health plan, the special IRS program. If you have the high deductible health plan, it makes you eligible, so says the IRS, that you can have a health savings account, which is very different from medical reimbursement. However, you can have a medical reimbursement if you have the high deductible health plan. And the difference is this wraparound flex is still a use it or lose it, just like the other one. If you do 2,500 and you can't claim it, we're going to keep it. But it will only reimburse things that are not covered by the health insurance. So the regular flex, you go in and get a $200 bill at urgent care, and that applies to your deductible. It's considered covered, even though you have to pay it. It's covered by the health insurance, and then it counted. So your regular flex would reimburse you that. This will not, because it was considered covered by the health insurance. So why on earth would you want to do this? If you have a health savings account, this allows you to put money, just like the flex, into your own bank account. It's got to be a health savings account at First Interstate or wherever you bank at. It's pre-tax. Then you manage that money. So if you're putting $100 into your own HSA account at First Interstate, so that in the future you can get medical claims reimbursed to yourself, usually then it's a checkbook. So you have a checkbook register, you have a debit card you can use. So when you go to Safeway, you can just run that debit card and pay for your prescription out of your health savings account. That limit for the IRS is much larger than is the $2,500 limit for flex. So you can put a ton more money in. You never lose it. It's not a use it or lose it. So you can build that money up over the years. So a lot of people, if they have the high deductible health plan, they're dripping money into a health savings account, which is tax-free, but then their kid has orthodontics or they get eyeglasses. They may not want to dip into this money that they're putting into the health savings account, so they can use the wraparound medical reimbursement account for their kids' braces, because that's not covered by the health insurance. So if this is a use it or lose it, the wrap. The HSA is not a use it or lose it. So they're just two tools that if you have the right health insurance plan, the high deductible health plan. So if you have any questions or want counsel on, these are some, I mean, you have to make the decision, but it's simple and yet confusing, but you just have to know how to use it, and you can really use it to your advantage.
So Karen, is there like a profile of the kind of age or health or marital situation where a person would just absolutely benefit from this?
There's not anything out there in print that would kind of walk you through an advisement of if these are your things, these are what you might consider. The real thing with all insurance is how much risk can you handle. So I carry the $2,000 deductible because for several years now, we haven't had any real medical issues. And gosh forbid something big bad happened, I still only have a $2,000 deductible. I mean, if I've done a $100,000 inpatient stay, I'm still only on the hook for $2,000. But that saves me all the money I'm not giving group insurance, the state, group insurance, when I'm not, just for the privilege of having the insurance. If you've got a really significant issue in your household where you know you're going to use your benefit all year long, you would take the $500 deductible potentially, but you have to balance how much you have to pay up front for your deductible versus how much money you're paying in premium. If you use that calculator online, figure out what your out-of-pocket for your paycheck is, times 12, and compare that to how much you would pay for your deductible, say for the whole family. You have to judge that risk on your own. I hate to in any way potentially sound, I don't know what the word is, but a lot of times single men, young men will take the high deductible health plan because they don't have any issues going on, so they save the most premium. I would love to do the health savings account. You could stockpile $15,000, $20,000 in that account over the years if you were just dripping money into it, and use that for your retiree premiums later. You can actually will your health savings account to somebody else. It still has to be used for medical expenses, but you control it. If, let's just say I have the $3,000 deductible and I'll put money into a health savings account, and then I find out I blew out my knee, I need to get knee surgery. I can, if the universe is working with me and I find that out in October that I need the knee surgery, I can every year in November for the open enrollment change my deductible. So I'm like, oh, I need knee surgery. So I'm going to switch to the $500 deductible because I'm going to incur services. So you can no longer contribute to your health savings account because you don't have the right account, health deductible, but you can still use from that health savings account for your medical expenses. To save tax-free money that you never lose, because we're all going to have medical expenses down the road, I just think is an invaluable tool. But you have to be able to afford your deductible. $3,000 isn't, I mean, I have 2,000 right now, so 3,000 is not a much bigger stretch. For me, the issue is those prescriptions because they work so different. I don't know if my budget can tolerate $190 for one drug, you know, and you don't know what those drugs cost until you go in and get them. So it just takes some pre-planning, and it's kind of what we're there for. So if you need any counsel, I mean, by all means. I mean, we're always going to tell you that we can't make the decision. We're not going to recommend what you do, but just kind of help you figure out how to assess what risk you think you can handle. So, and what's interesting is that with the flex accounts, the flex reimbursement accounts, if we get audited, we are the ones that will get audited by the IRS that we reimbursed you properly or gave you things you can't have, which is why, well, it's my money. It is your money, but we can only reimburse you what the IRS says we can. When you do a health savings account, you manage that. We don't police that. You're the one that will get audited by the IRS if you're inappropriately spending it. Not quite sure how what flags go up there. You could, let's say you have $5,000 in your health savings account and you're like, I'm an emergency, I need this. You can use it for something other than medical, but you'll be taxed heavily and you'll have a penalty just like you would kind of in a cashing on a 401k kind of thing. But as long as you use it for medical expenses, it's tax-free and you're good to go. So that's getting you enrolled and the basic benefits. Any questions that have popped up about any of the benefits that are on the tip of your tongue? Yeah.
So then we're enrolling now, excuse me, in March. When you said at the beginning that it starts 31 days after your date of hire, so yesterday was my date of hire. So then I have 31 days to sign up or make any changes, but the actual insurance will not start until April 1st.
Right. If your data hire is 3/1, you'll start 4/1. And technically, I mean, if you turn them in this week because you know what you want, you'll start 4/1, and that's what we'll enroll you in.
Mm-hmm.
But if you've thought about it later and decide, you know, I really think I want the vision, you have until the end of April to turn in a form to revise your election.
And then,
No, well, and even if you change your mind and revise it, it's still 3/1 that it would take effect. But
or 4/1.
yes, 4/1 because your data hire is 3/1.
I was just making sure.
Yeah.
I had a question on the vision. Do they send you a card or something?
You know, no, there is no card provision.
So you just go and say you're a member of this
It's-
program?
It's your social.
Okay.
I have vision through the state of Wyoming, and they should just act. VSP is a national vision service plan, so you should be good.
Okay.
Yeah.
I remember my
Okay, good. Shoot.
So, like I said, so if our insurance starts April 1st, just for today, then will we have to then again re-enroll in November?
No, November is open enrollment. That's the period that group insurance allows you to make changes.
Oh, okay.
Yeah. You don't have to do anything, and everything stays the same. Okay. Alrighty, so because we have you as an audience, we want to make sure we talk about some changes. So going forward, you know what to do. Anytime you have a qualifying event, which is your spouse has lost coverage somewhere else, or you got married, you had a baby, there was a divorce, something significant has happened that is considered a qualifying event to change your situation. You have, again, 60 days for everything, 60-60. If you miss the 60 days, you don't get insurance, or that person you're trying to add doesn't get it. You have to wait till the next open enrollment period. And as always, there's the documentation deadline. Supporting documentation has to be within 30 days of the app deadline, so you have plenty of time. I will tell you that if somebody has a baby and we get the application on the 50th day from the date of birth, we're going to put that child on the date of birth because you're still within your window of opportunity. But you're now going to owe potentially some additional premiums because it's been 2 months since a baby was born. If you're going from single to employee plus child, and we put them on, you know, December 20th, because you're still within your time frame, then you're just going to owe additional monies. If you get married, the state of Wyoming and group insurance, there is no retro. We don't do partial months. So if somebody is to get married the 15th of the month or earlier, they owe for their spouse the entire month. If you get married on the 16th of the month or after, we still put you on date of marriage, but we don't start charging you for that additional person until the next month. Birth, 60 days, that's usually what gets fouled up for folks as they miss out for their baby. If your spouse or somebody loses, they have loss of coverage, or you opt not to take the health insurance through the state because you've got it covered through your spouse. If you were to lose that coverage through your spouse, now you have a loss of coverage. It just can't be voluntary. You can't decide the state program is better and just drop that one. You have to be ineligible for it by having your spouse termed or something to that effect. We have to know who lost coverage, when they lost it, and why. Usually a COBRA notice is the first thing that we get from folks, because when you're offered COBRA from an employer, it means you're not eligible for their active benefits anymore. Coverage goes into effect the first of the month following receipt of your app. So birth and marriage, we put you on birthday and marriage date. Everything else is the first of the month following your app. So let's say you lose coverage through City of Cheyenne. You've lost it on February 1st, and you wait until March 7th to turn in your application. You're still within your window to get applications in, but we're going to make it 4/1 because you turned your apps in March. So just be aware that you could end up with a gap in coverage depending upon what your qualifying event is and what your timing is. So we give you more opportunity, but everything's the first of the month. So court orders, divorce decree, when we get those aren't actually a court order to the state. And what's interesting is when you get divorced, your children are still your children. Your spouse is not your spouse anymore. So we will occasionally get people who've turned in an application and want to add their children because they got divorced, but the status of your children has in no way been affected. That doesn't sound, you know what I mean, from a legal standpoint. So we don't let you add your children to the program because you got divorced. You're ordered to cover them somehow. It doesn't override the state's program rules. Permanent legal guardian, it can't be temporary. We do get applications to add their grandchild because now they're a guardian for them, but it has to be permanent. Medical support order, these actually come from Child Support Services, and this is where Child Support Services or type situation, they're ordering the state to cover. So the employee doesn't have a choice anymore. But the big thing that comes up is a lot of folks don't realize that divorce decrees don't mean, and the divorce decree says that bills, I'm supposed to provide the insurance. Your children were your children before, they're your children now, they could have been on all along. So this court order does not mean we're going to let you add them. So. But the important thing I want you to walk away from is that if you need to make changes outside of like a special open enrollment, 60 days is what I want you to walk away with. So open enrollment is every night. It's technically October 1 through November 30th. You have 2 months to make changes. I don't know, we can't give you any more time than that. It's 60 days. So if you're like, I think I need to change my deductible, your flex changes for next year are due by November 30th. Everything is kind of a drop dead November 30th. It has to be into your HR and date stamped by November 30th or we won't honor it. You can change your deductible every year. You can add or drop dependents. Open enrollment, meaning carte blanche, you can just have it, no questions asked because it's open enrollment, applies to health insurance and the preventive dental. So if you aren't carrying either one of those and you decide I'm going to add me and Johnny onto the coverage for January next year, we'll give you health and preventive. You can't have optional because there's that 3-year waiting period. There's lots of rules that make sense to me because I do it every day. So I'm going to say it again, please call us if you need anything because that's what we're there for. If you're covered with health and both dentals and you just didn't cover Johnny, now you decide, you know what, I'll go ahead and put him on next year. Even though he's been without the optional dental, he didn't have it, because you have it, he has to have it by default. So we would put Johnny on health and both the dentals that you have, if that's what you were electing. So it's simply a coincidence that the dental optional and the vision we allow you to do during open enrollment. That's the time frame, but it doesn't mean you can just automatically have it. So you may apply for health because you didn't have it and we give it to you, but we deny you the optional dental because you haven't met the 3-year waiting period. So semantics, but it's important that what open enrollment really means is health and preventive dental. We offer retiree insurance, which is actually pretty awesome. I do think there's plenty of big employers that don't tell you to let the door hit you in the rear on the way out, but you walk out and you don't have any insurance to continue on. So it's pretty awesome that we do. You don't have to qualify for your pension in order to be a retiree in our eyes. You just have to be 50 years of age and have worked for at least 4 years, or just have 20 years of service. If any of those are met, then you can keep insurance as a retiree once you exit the state. We have to be notified that you're terminating. We send you a retiree packet, and then it's up to you to enroll in the parts or pieces you want to keep. The one caveat, let's just say you work for 10 years and you're 60 and you retire, you decide, oh, this is pretty great. I'm going to keep the dental in the life, or I'm going to just keep vision, or you want the whole ball of wax. You have to have had your own coverage or your dependents covered for at least 12 months before retiring. We have had incidences where somebody qualifies as a retiree, they've left, They just added their spouse on during open enrollment January, and then that June, they retired. Their spouse was not, and we didn't let them keep their spouse on. It was awful. But he wasn't able to change his retirement date. He had to do it in June. So
And then the employee is responsible for it.
they have to get insurance somewhere else.
No, I mean,
Oh, yeah, yes. Retiree insurance is 100% paid by the employee. Currently, there is a retiree subsidy that, based on how many years of service you have, you get a credit towards your health. It's $11.50 a month if you're not Medicare eligible, times however many years. So 35 years of service, 30 years of service is the max. 30 years of service times $11.50 is going to give you $345 credit off your health, only the health. So if you took dental and vision, you get no subsidy. And then once you're Medicare eligible, the rates go down, and so does your subsidy. It's $575 per month per year of service you have, maxing at 30. $172.50 is the credit. So dare I say, since I'm being recorded, better than a poke in the eye, but it still helps out a little bit. But otherwise, you pay it. Here's a copy of the Flex claim form. It's out on our website. If you fill out the claim form, there's a medical section and then the daycare, so there's only one form. We need the EOB from Delta Dental or the explanation of benefits from Cigna. That shows what you're really liable for as the member. So just because you paid Cheyenne OBGYN $800, the EOB shows you're only responsible for $760. We're going to reimburse you $760. The great part about making sure that you see, like I said, that contracted provider is that even though there's a percentage that's paid, anything above that percentage, if they're a contracted provider, they can't bill you for. So unfortunately, when I go to the doctor, I don't say I know too much, but it'll be this much money, and I say, is that with the contracted discount or not? Because I don't want to pay more than I'm supposed to have to. A lot of times you pay it, and using insurance, you really got to be an educated consumer. You have to know what you're doing, not to suggest you be taken advantage of, but just to use it the best way possible. You get a bill, you pay it, and find out later you weren't supposed to have to. Well, good luck getting your money back. And then you just have to do a bunch of more work and hoops. So just, if you have any questions, call us and just pay attention to your insurance if you can. It's not the funnest, but it's important. So this is the claim form. There is a flex change form out on our website too. If you didn't do medical reimbursement and now you have a baby, well, now you have an additional dependent you're going to incur expenses on. You can add daycare. You can add medical reimbursement. This form is great because it gives you some of the examples of what constitutes you being allowed to modify your flex. Your spouse terminates employment, and so now he or she's not working. Well, you don't need daycare, so you can drop the daycare. Your kid is in daycare, but now it's going to start kindergarten mid-year, so you need to drop it or reduce it. You can do that. So just know that that's out there. You've got 60 days to do it. The hard part to keep in mind too is somebody has a baby, so they're like, oh, I'm going to increase my medical reimbursement. However, it takes effect the first month following your flex change form. So you have a baby in February, turn in your form in February, we make the change 3/1. So that would be for services incurred 3/1 forward. So you're not going to be able to increase it and then go backwards and get money for claims that were prior to that. Bookmark our website for all your insurance needs. It's just egi.ohio.gov. Our booklets are out there, applications, the schedule for when deadlines are for the medical reimbursement and when they pay out is out there. Our Benefit Press newsletter, we send it out electronically through Google Mail. That's where you'll find copies to that. This will give you links to get to Cigna, Delta, all sorts of exciting places. We do have videos out on the website. They're being revamped probably within the next 90 days. So the health and the dental is a little bit outdated because our deductibles did just change January 1. But if you want a refresher later, the basic bones of it is the same. There's actually words down below the video that tells you what's different than the video, but you can go out and watch those if you want. Any questions? Yes.
Could you rephrase what you said about the contracted network?
Yeah, absolutely. The thing to do is you've got in and in. If you're in network and in Wyoming, it pays at 85%, and you're only responsible for the other 15. If you're out of network and out of Wyoming, it pays at 60%. Those are the two, like the bread on the hamburger. The two in the middle is if you're either in network and out of Wyoming or out of Wyoming and in-network, they pay at 75%. But globally, any services you have done, if you can at all costs try to see a contracted contracted provider, they've signed a contract and agreed to a discount. So even though it might pay at 75%, if they're contracted, you're responsible for the 25%, but nothing else above it. If you see somebody that's in Wyoming, but they're not contracted with Cigna, you're going to pay the 25% and then anything else above and beyond that they're going to bill.
But what do you mean by above and beyond?
Well, if they bill $200 for a visit and Cigna's agreed upon contracted amount with them is $50. Did I say 100? Is $100. They bill $100 and the contracted amount that's allowed is $50. They're going to pay 75% of the $50. You pay the difference. But then there's still another $50 above the allowed amount that they billed. You're going to be responsible for that too. So to minimize how much you have to pay, if you can see a contracted provider, they write that off, they eat it. But if they're not contracted, they may accept our payment. You're stuck with the 25% of the allowed plus anything up to what they actually billed.
Okay.
So in-network is always your best advantage. But I mean, because if you still pay at 75%, you can doctor wherever you want to. Just know that you might be on the hook for a little bit more. So, yeah, pay attention to your EOBs when you get them from Cigna because that really will spell out. You can see, oh my God, my doctor billed $354 for a sports physical. Are you kidding? That kind of stuff helps drive premiums and drive healthcare as well. I might consider taking them somewhere else, but you can see how much of it was billed, how much of it was allowed, and then it will show you on the explanation benefits what the employee or the member liability actually is. So you know how much you're really responsible. If you were to check for $80 and it says you owe $53, you would be calling Mr. Dennis saying, you know, I got my EOB and it says I only owe this, and they shouldn't give you a hard time with getting your money back. But just be cognizant. Those EOBs come out from Delta and Cigna every time they process a claim. So you should get that every single time. If you guys need anything, though, do call our office. Do.
What's
Yes.
Is that the same for ALEX?
What?
The
For-
ED?
Oh, that's for everybody. Yep. Usually your AWAC or TPO1 or probationary is only how much match they get or what waiting periods for enrollment are, but everything's the same for everybody. The direct line is 777-6835 is our main number.
Do you guys help, like if we had an IRA someplace else, do you guys help us roll that over or who do we talk to about that?
That's a good question. I'd go to my HR.
The BRS, our next presentation.
Okay.
Oh,
Okay.
very cool.
Good.
So do you have anything with you about rates?
I don't know, Chris, if you've got the ability, if you wanted to pull up the website, we can kind of cruise out what, unless people need a potty break or something, we can pull it up if you want to look at it. The rates are out on our website and they're pretty, it gives you the state contribution as well. So since you know the math is match minus the life minus the health insurance. In fact, on the website, there's a calculator as well. So it doesn't help you fill that out right now.
Not really.
But if you really wanted to, for the sake of you guys being able to do it, and then even give us a ring today, you could print off a rate sheet off the website and then give everybody one you need.
Okay. We'll conclude the presentation when there are no more questions, and then we'll pull up the rates for anyone that wants to stay during
That's
the break.
Yeah. All right, well, that's all I've got. If you need something, give me a shout, or us a shout. So,
Thank you
Thank
very
you,
much,
thank you.
Karen.
yeah, no sweat.